Today, folks, one of my all-time favorite dividend ETFs, SCHD, is about to go through a 3-for-1 stock split, and I want to talk about what this means for my holdings, and we're going to break down SCHD and where it currently sits today for newer investors that might be looking for dividend income, not as financial advice, but from my own personal perspective, having 90,000 Canadian dollars sitting just within this one ETF in my RRSP. If you're a Canadian buying over-the-border stocks, it's best to hold U.S. dividend stocks within your registered retirement savings plan to avoid that 15% withholding tax and be able to reinvest and compound this money at the most efficient way possible. I'm currently up 12.5% since I've been buying this ETF over the last few years, and I'm going to keep buying a lot more. I have this set up on a drip. My goal is to get over 100K Canadian in here, hopefully on my next contribution by next year. But if we take a look, let's start with the dividend income itself and why this is such a resilient ETF, and why, if you are an income-oriented investor or heading into retirement, this is the holy grail. This is the gold standard of what every dividend income-oriented investor is trying to achieve, right? Looking for stable income that grows and outpaces inflation. We're talking about a decade ago of 25 cents versus the peak dividend in 2024 being 82 cents, representing a well over 3 times your dividends, right? Like, I mean, you 3 extra dividends in a decade, which is absolutely insane. Imagine getting a 3x raise. That's never going to happen at your job in a decade, right? Unless you move jobs. But in comparable to VOO, representing the S&P 500, which is the largest position in my portfolio, I do not believe SCHD is an end-all be-all solution to investing, but it pairs very well with helping grow against the S&P because, again, the S&P is a passively weighted, or VOO is a passively weighted index based purely off market cap. It has nothing to do with fundamentals, whereas SCHD does. But from 78 cents a decade ago to $1.78 is representing just over a 2 times, right? So you're giving up 30% growth difference, but again, very different funds with very different objectives. If we take a look at the stock performance over the last 5 years, comparably with the dividend, you would have probably got around 4% back a decade ago. You could probably tap on an extra 20% to SCHD's return of 53% in the capital appreciation. But again, VOO is probably paying about a 1.5 percentage points back then as well. So you could easily tap on another 7 to 10% there. But you can see that we've been lagging a little bit in difference. And I think this has a large effect to do with interest rate sensitivity as well. And I'm starting to speculate that as interest rates come down, SCHD will start to perform much better. But I'm still a huge proponent that the future is largely going to be in tech. The growth of tech is going to continue to be absolutely extreme. And I think over long periods of time, the S&P should outperform SCHD, though through its history, comparably, SCHD has actually kept up very close performance to the S&P only as of late, because keep in mind this chart performance doesn't go back far enough to match VOO over the max period here. But even still, 5-year, I think the performance of each of these is great. And we're going to break that down a little bit more in depthly here before we talk about this stock split and what it means. But basically, just to give you an idea of how this fund is structured, basically all index eligible stocks must have sustained at least 10 consecutive years of dividend payments, have a minimum float adjustment market capitalization of 500 million USD, and meet a minimum liquidity criteria. Now, the index components are then selected by evaluating the high dividend yielding stocks based on the 4 fundamental base characteristics: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Stocks in the index are weighted based on the modified market capitalization approach, kind of similar to the S&P. No single stock can basically represent more than 4% of the index, and no single sector as defined by the index. Now, this is awesome because this is exactly what income-oriented investors are trying to do, right? Especially when you take a look at the expense ratio, that if you put $10,000 in here over 10 years, you'd have only paid $77, which is just absolutely awesome. But if we can kind of take a look a little bit more in depthly to the returns, and I want you to keep in mind this fact sheet is a little backdated because it's as of June 30th, 2024. And we all know as of recently, SCHD has shot up quite a little bit, because you can see on the 3-year return here, it's about 4.55% annualized. But if you look at the 10-year return, it's 10.84%. I'm presuming as the market kind of nominalizes into lower interest rates, the returns will definitely start to peak up a lot better. But if we scroll down and just take a look at a few other factors that are in here that I find very interesting as well, when you take a look at the sector weightings, and again, financials at 17%, healthcare at 15%, consumer staples 14%, way more diversified than the S&P 500 is, because again, I feel like this is directed at every passive income investor strategy, which is diversification, reliable, growing income. Now, I want to break down the holdings here, but before we take a look at the top 10, I do want to point out that this is insane, right? Like the price to earnings ratio on average right now is at a 16. It's probably accumulated a little bit higher. And I also want to point out something very interesting here. If you're wondering how they can charge such a low expense ratio, it's because this fund has $54 billion in it. Like, this is an absolutely absurdly huge fund, right? Which I love because it allows us as investors to get a much lower expense ratio. Now, these top 10 holdings, I think, have adjusted slightly. So let's break them down based on, actually what's on the front end of the website here for SCHD. Now, again, before we just dive into that, I do want to point out that the effective October 10th, 2024, this ETF will undergo that 3-for-1 stock split, which essentially means that it has absolutely no impact on you whatsoever. It just means for every one share you currently have, it's going to be split into 3. I don't know if I did the exact math on it, but let's presume what's one share worth today. I mean, one share is sitting at about 83.67. So if you take 83.67, divide that by 3, you're going to end up with about a $27.89 a share price is what we're going to end up with. And it's a psychological thing, I think, for the most part. A lot of people hate this because it tends to drive up this psychological idea that, oh my God, it's cheap now, I can afford to buy more. It allows, people that might not have as much money or higher incomes to invest and get more shares at a lower cost. But really, it's not changing anything. It doesn't change the value of the shares. It's just a psychological effect, but I think it's going to do much better for people in a lower income, right? I think it gives more accessibility. It's a good thing, right? It's something that I think is appropriate once you start approaching $100 share price. Many big mega cap companies have done it over the last few years. We've seen it happen time and time again. So basically, come up October 10th, pay attention to your account because trading on October 11th, you will see a lot more of those juicy SCHD shares in your account. So as we take a look at the top 10 holdings today, we're going to look at these on an individual basis to see how they're doing this year. And I love the diversity here because these are some of my favorite dividend stocks, which is why I'd rather just cost average into SCHD because, as mentioned, Home Depot has turned around dramatically here, now up 15% year to date to the largest position in the portfolio. Not at all-time highs yet, but again, the real estate market has been trying to pull itself out of a very tough market environment, a higher interest rate environment, which dampens, the performance of Home Depot because less involvement in real estate means less construction costs, less, like, people just aren't putting as much money into, repairs or anything that can add value to a property because they're doing it at higher interest, right? But here we are. We're starting to see the turnaround finally. Verizon, one of my favorite sectors is the telecom sector here in Canada and in the US because it's where some of the greatest values sit. And we were saying this for the last couple of years, actually, and it's taken a long time for Verizon to pull its head out of the sand, and it's starting to, and I think it's going to continue to, as again, these are interest rate sensitive industries, right? Like, this is why I think SCHD is an interest rate recovery play. So you look at something like Cisco here, this one's up 5%, again, starting to rally on the back of interest rate cuts. BlackRock, this one's been doing exceptionally well this year, up 18%, kind of keeping more in line with the S&P, but again, still trying to pull itself out of the long run downtrend that it has been going through. Now, Pfizer, again, keep in mind this fund is constantly updating these stocks. Pfizer is a really interesting one because obviously coming out of the pandemic, it got absolutely slaughtered on the back of people just not getting vaccines like they once were. So it's kind of incredible to see just the struggles that this company's gone through and the wicked volatility over long periods of time. These are the kind of stocks that when I look at them, and same with the Canadian banks and many other dividend stocks, is if you are an individual investor trying to play these, you really want to be playing them when they're heavily discounted because you're not looking for the total return to matter as much as the dividends and the dividend growth. So it's more prevalent to be buying them when they're at crazy discounted levels, right? Or when they're trading well below 52-week highs. And that's where a lot of these stocks are sitting, which is, again, another reason that I love investing in SCHD so much. I'm not the biggest fan of the oil exposure, however, because oil is cyclical no matter what, but it has always been a reliable place of getting stable income for the most part, with the exception of a few periods in time, again, like the pandemic when oil went negative. But we see Warren Buffett, a lot of other investors buying different kind of oil stocks. And honestly, over the last, quite a few years here, we've seen oil do exceptionally well. So we're going back into the cyclical down period as it stands right now for the oil industry. Now, when it comes to geopolitical events, you're not going to do no wrong with Lockheed Martin, one of the best performers in here this year, up a whopping 27%. Congrats to anyone that bought this over the years because As people mentioned, geopolitical war, it's just part of human nature. And Lockheed Martin, I know it's a moral thing that you're gonna have to debate on whether you want to be supporting, weapons and all this stuff, but it is a fact of reality, and it is one of the largest companies in the U.S. at $138 billion. You have Texas Instrument doing very well, up 22.8% this year. Bristol Myers Squibb, another healthcare company, not doing so well this year. The healthcare sector has been in a bit of a slump, but again, you got to ask yourself, with these massive yields that they are paying, based off affordable income that they still have to pay these yields, they're probably good buying opportunities to be in more stable, reliable sectors. You got Coca-Cola here as well. I shouldn't say stable, actually. I mean, clearly there's a lot more volatility than you'd think to the healthcare sector as a whole. It's stable. On an individual basis, there's always volatility. And then finally, we have Coca-Cola, another Warren Buffett favorite that is crushing this year, up 18.82%, with a very awesome yield, and has been just probably more stable than the healthcare sector seems to be. But I love all these stocks. When I look at these and I kind of continue to go through even the bottom half of the list, you'll see, actually, if we can see the full list here, if we can take a look and just, actually, no, we just want view all holdings. I shouldn't be exporting the file. But if we take a look here, yeah, then you're going to get AbbVie in here, United Parcel, UPS, which has been struggling. But I love AbbVie. Pepsi's incredible. Altria Group, the tobacco sector has been pulling itself out of the ground, though I wish this was Philip Morris or British American. You have U.S. Bancorp in here. Kimberly-Clark's another good one. Ford Motors, not the biggest fan of, but hey, Hershey Foods, another one that I absolutely love. Again, you can clearly see why there's so many investors out there right now that are starting to pool their money and diversify themselves with funds like SCHD, because it is just such a brilliant ETF and will remain a core aspect of my portfolio. But I'd love to know what you think in that comment section below.